Okay, so good afternoon, everyone, and welcome to our webinar, Raising Investments for Energy Efficiency Projects. My name is Lina Konstantinopoulou. I'm the Executive Director at SEFA. SEFA represents the sustainable energy finance ecosystem, including finance institutions, sustainable energy developers, one-stop shops, engineering companies, retail energy companies, not-for-profit associations, but also NGOs, with the whole mission to accelerate the transition to a net zero carbon economy and advancing the development and financing of sustainable energy across Europe. I have with me two very distinguished speakers, and I would like to ask my colleague Talvin to put the slide on.
Alrighty, I'll just go ahead and do it.
Thank you, Talvin. So it's with great pleasure to introduce to our speakers David Canarocci, the CEO of GNE Ventures, with an academic background in industrial engineering from the Polytechnic of Turin and an MBA from ESAD Business School. He's leading GNE Ventures, an advisory and investment company dedicated to energy transition finance. And David has all the experience in orchestrating investments. He has exceeded more than 100 million across diverse sectors, including energy efficiency in industries, renewables in municipalities, building renovations, and eco-mobility. And he also serves on the board of directors of the European Sustainable Energy Finance Association. In addition to that, we also have Michael Pachlatro, the European Director of Joule Assets. Michael is the European Director and also the project coordinator of 5 consecutive EU grants for sustainable energy finance. He's a CFA charter holder and a founding member of SEFA and also serves as treasurer. Now, we will have some exciting presentations by both of our speakers, which will delve on exploring on what financing tools and investment strategies are most effective, not only scaling up companies and having more about corporate finance, but also looking on project finance and scaling up energy efficiency projects. Now, before moving to our speakers, and I would like to welcome both of them in this panel, I would like to provide some context behind this webinar. Now, we have seen that the global energy investment has been picking up. And of course, we all have read the famous Draghi report, where he has been talking about a massive investment of around more than 800 billion in additional annual investments, equaling to 4.4% of EU GDP. Now, the EU has identified the need to increase investments in energy efficiency by a kind of 1/3 to the massive investments of Draghi, 260 billion per year, in order to meet the 2030 target. So even though investments in energy efficiency has been increasing, of course, we all know that it's not on track to meet the ambitious climate scenarios. And of course, energy efficiency is not only crucial for large companies, it's also very crucial for small and medium-sized enterprises. And on the financial fronts, we all know that SMEs typically do not have the necessary financial resources to make these investments, and awareness remains low in the funding opportunities. And what is the missing piece to scale up financing? And this is why I would like to first ask Davide to share his slides for the first presentation. Thank you. Thank you, David, for joining us.
Thank you very much, Lina, for the introduction, and welcome everybody who's been joining us for this webinar. It's a pleasure to be here. Let me know if you can see the cover of the presentation.
Yes, we can.
Okay, thank you very much, Delvin. So I will spend a few words for the next 15 minutes about the challenges and related to raising investments in this sector, which is energy transition, sustainable environment, and climate tech. As you can see here, just let me spend a few words about Genie Ventures. Lina has been very kind to give a first introduction. As we are a group of companies that are solely focused on advisory and investment in the energy transition and climate tech sector. We got started as entrepreneurs back in 2009 in this sector in energy efficiency and distributed power generation. Then 2016, we launched Genie Finance and Genie Ventures. These are that you can see here are the three people that are solely focused on investments. You have a little bit of information about us, where we studied, what we did, the partners that we worked in different projects from public administrations like municipalities to large corporations quoted in the Spanish Stock Exchange, because the company is based in Barcelona, and institutional players like the World Bank and the European Investment Bank. So as I said, we now have 8 years going on. In these last few years, we have been focusing more and more on trying to address the challenges related to how to provide companies and players like promoters, developers that are operating in this sector to address the lack of capital or the investment gap that we will discuss in a few minutes. And that's why a couple of years ago, we developed our investment theory, which is named Financing for Equity, that we tested with our first investment vehicle, which is named Genie Invest One. We executed our first investments. We will see today one of the investments that we did as a case study, Solarmente, which is a solar photovoltaic company based in Spain. And then since this year, the holding company, which is Genie Ventures, became an operational company and solely focused on investments in this sector to boost the development of this activity. So let's try to put some context to the introduction that Lina briefly made. First, on the left side of this slide, you can see the evolution of investments in energy transition in since 2008 till 2023. So in the last 25 years, as you can see, there's been until 2019, so just a few years ago, a growth, kind of a low linear growth, and then starting from 2020, investments in the sector really shift gear and have arrived last year to an impressive volume of almost 1.8 trillion globally in overall investments. So this is a very important growth. It's a testament of what has been done already in this sector. But if we focus on the projections for the next decades on the right side, we'll see that much more growth is needed in the coming decades, leading to a 3-time increase at least of the investment size from here to 2040. And as you can see, these mountains, this kind of cliff that we have here in this graph shows you that even though a lot has been done, much more investments are needed in the sector. As we say here, additionally 3 trillion per year. So I repeat, $3 trillion per year is a massive amount of investments are needed in the sector. And so it's really important to understand how this investment gap can be addressed. Let's now focus on the companies. They can be startups, SMEs, but even corporations or promoters that are working in this sector have to, the challenges that have to be overcome, which are, this is a sector that is capital intensive, because lots of the solutions, the projects, the technologies that are developed or that are deployed are what is called hard tech solutions, which means that equipment, hardware, infrastructure, and complex projects need to be executed. And the vast majority of these projects require upfront capital. Therefore, it is very important that operators in the sector can figure out how to have the right access to the capital and to the right capital. And to do that, it's fundamental to be able to answer to a question, which is, in order to build my optimal capital structure, we need to understand what is the type of business, what is the stage of development, the maturity of the technology that are implemented, what is the business volume, and the existing capital structure of the company or the SPV that is promoting this kind of investments, and what are the goals of the companies and the investors that are involved in these transactions. Once we have the reply or the answer to these questions, we need to focus on how to build in every given point in time of the development of a project or a business or a pilot project, the right capital stack. What is the capital stack? As you can see on the right side of this slide, especially when we talk about projects, but sometimes also when we talk about companies that are heavily involved in hardware and infrastructures, it is very important that companies know how to build their optimal capital structure, that it can be done from the and common equity, which is considered the layer of capital with a higher appetite for risk, but that in exchange, of course, demanding the highest return. And then we go down to preferred equity, mezzanine or junior debt, and senior debt, which are form of capital that are less inclined to risk, but that have as an expected return that gradually goes down. Of course, as you probably know, a senior debt is called senior because it has the priority over any other form of capital in a given structure. So when your company needs to address how to build the optimal capital structure, it's important that there's a proper mapping of the players that can be tackled for each layer of capital, from senior debt that, as you can see here, is a lower risk appetite, but also lower expected return that can be made by banks, insurance, in some cases also some institutional funds. And then we move to junior and mezzanine debt and private equity, which are forms of private capitals that can intervene in the capital stack of both companies and projects, and ending up on the right hand to venture capital, venture debt, that are the forms that can bear the highest risk, but also expect the higher return. So when players have a proper information about their needs and the answer to the question we see before, they are able to determine what is the optimal capital stack that is needed in a certain moment. Let me say that you are not alone in this challenge. There are lots of information that you can find online. For example, this slide is taken from Climate Tech Venture Capital that made a very good job at mapping the different players in the different type of capital. So you can educate yourself a lot on the different players and what they can offer, and in which moment you can have access to this capital provider. So let's dig a little bit deeper into the characteristics of the different type of capital. Here you can see that if we go from the left to the right, from the most conservative form of capital, which is senior debt, to the higher risk, which is venture capital, you can see that they have different characteristics from decision-making speed, the cost of capital, the risk level, the flexibility, the repayment in terms of seniority, and the dilution of the owners of the companies or the SPV, the vehicles that are promoting certain projects. And so, of course, just to make an example, if we talk about decision-making speed, the venture capital and venture debt usually can be very quick. Then private equity and mezzanine, they can be decently quick. And the contrary, banks, unless you have already existing relationship, are normally pretty slow. But then, of course, there's an exchange when it comes to cost of capital, as we discussed before, and that is associated to the risk premium they are willing to take, the flexibility in the form of capital, and the seniority we discussed. And the dilution is also very important, especially for funders and investors, because forms of capital like venture capital, for example, are highly dilutive. While form of debt like senior debt, venture debt, and usually mezzanine are non-dilutive. And here you can find some more information. I won't go through all of it. It's quite a dense slide, but basically it digs down on what are the characteristics of the different parties that can provide capital for your business or your project or your portfolio projects. Very important also the difference between a portfolio project that is in construction or a portfolio project that is already up and running and delivering already cash flows for investors. All these forms can be addressed in a different way by the different capital providers. So just to make an example, if we focus on impact investment funds, you can see that their focus is on social and environment, generally speaking. You can find players that can address the full capital stack. In other words, you can find impact investment funds that can provide from equity to debt, and so on. You can see the different characteristics of the different type of capital. So when you go looking for the right source of capital for your needs, it is very important to have a clear mapping of where you are in terms of your business and who are the players that you can interact with, that you can access with, in order to knock on to the right doors. And here, a quick case study or example of what we do. This is, for example, an investment that we did last year in Solarmente. Is a residential solar photovoltaics operator in Spain. They are a startup that is being selected in 2021 by Y Combinator, which is the most important incubator of Silicon Valley. They are highly focused on technology in order to deliver savings to their homeowners. Why did we invested and start to work with Solarmente? Because when they met us, they were focused on selling solar installation and then managing them. And they saw that larger players in Germany or in the US, where the residential solar photovoltaics market is more developed, they saw that develop different type of business model based on selling solar as a service rather than having to have a high upfront investment. And that is what we did for them. We created a off-balance sheet financing company named Beyond Solar Solutions that basically can provide the type of capital that they need so that they can provide to their clients, install solar photovoltaics, batteries, recharging stations for electric vehicles, heat pumps, and other solutions at zero upfront cost for their customers. In other words, it's as simple as to subscribe to Netflix. The homeowners can subscribe, they get their solar installations, and we created the engine that powers the whole machine, and they can provide these solution of solar as a service to their clients. What does this provide? This provides the capacity to address a way larger market, to gain more traction on clients, to offer a higher number of solutions and products. In other words, it creates a way higher lifetime value per client and increase the numbers of clients. The compounded effect of these two elements, it creates that the performance of Solarmente is increasing over time of a 3x compared to the base case study without the financing solutions that we provided to them. And if we move on to our conclusions, and I try to be as brief as possible, the importance of making the right choices when we are talking about building your capital solutions and your capital stack is fundamental in order to set up the foundation for long-term growth and stability. Selecting the right financial tools, as we saw, is fundamental for the value of your business, the value of the equity. In other words, if you are a funder, if you are an investor, you want to keep an eye not only on how the company is doing, but how your equity is doing, and of course, which kind of exits you have access to. On the contrary, mistakes can create diluted ownership, high cost, or sometimes if there's no access to finance, can jeopardize the whole business. So it's very important to have a clear path to success. And let me close with a funny drawing from Little Red Riding Hood, where we say that if she would have been properly advised, she would then end up in the belly of the wolf. And in business, there are no hunters that can get you out of the wolf's belly. So be alert and be smart about the choices that you make. Well, for the moment, I conclude my part, and thank you very much. And I hand over to Lina and Michael.
Lina, I think you are mute.
Yes, I'm on mute indeed. I wanted to introduce you, Michael, actually. So thank you very much for joining us. And we will now move to more the project finance side of energy efficiency projects. Thank you.
Thank you very much, Lina. Good afternoon, everybody. My name is Michael Bohlatko, and I today step in for Jessica Strombach, whom you might have seen on the promotional material for today. Jessica, unfortunately, is unavailable today, so you have to bear with me. thank you very much, Lina and Sifa, for the opportunity to speak today, and also to Davide in particular for this excellent presentation to really just outline the complexity and the variety of the different financing options out there in the market. I today want to briefly just say a few words about Joule Assets and then give a couple of practical scenarios how we have seen companies navigate that landscape in recent years. Joule Assets is a consultancy and a financing facilitator in the sustainable energy finance space. We have been active for 10 years now in Europe on a number of European initiatives, grants under Horizon 2020 and LIFE. We support energy service companies and project developers in navigating that complex landscape with appropriate project investment advice and third-party valuation, performance insurance, and so on. We have also been part of various regulatory and policy groups, such as EFIG in the past, or now also SIFA. Along that journey, we have been working on 3 consecutive projects, particularly on sustainable energy finance, supporting SME project developers. These were SEAF Launch and Propel. So over the last 7 years, these ultimately have seen the creation of the Sustainable Energy Finance Association last year. And throughout these years, we have supported the processing of more than 350 million euros of project finance opportunities, and engaged and built capacity and trained more than 200 project developers along the way. Now, all that being said, the focus today is on 2 scenarios. As I said, these are not particular case studies with names attached to them, but they're really typical cases of companies that we have been dealing with over the last years, and their particular challenges that they face depending on what stage of development they are in. These scenarios are certainly simplified, but nevertheless, they provide some good insights as to what aspects to consider and what upsides and downsides there are for the various options. So with that being said, let's look at Company A, a small innovative startup, relatively recently created. Maybe it had already 1 or 2 equity rounds, and it has a technology that is pretty mature, but maybe lacks the real market maturity, right? It's maybe at TRL 7 or 8. It has a very small corporate balance sheet, just little collateral, and definitely has difficulties to raise debt. Potential clients for first pilot projects are probably small, also with equally weak balance sheets. And the key risks to consider here are definitely credit risk, but also performance risk and technical risk when it comes to not fully mature type of technology. Now, what would we consider here typically to be the case? Clearly, there will be some corporate equity, right? Relatively small capital equity stack, but then what will be the options to really get projects financed? One option certainly could be with grants. You are aware certainly of the various European funding opportunities, some of which I have just mentioned before. There are a number of funding mechanisms for new technology in Europe, and grants can definitely provide a very interesting opportunity, not just to have, basically money to get at a certain technology to TRL 9 and to the market. It also provides an option that is not diluting equity in the company. It can create partnerships with other interested tech companies or investors. And there is a certain reputation coming from the fact that a certain due diligence had to be passed, right, to receive a grant. So that can definitely provide a head start as well for further financing after that. There is, however, an uncertainty whether the grant will be won, and it is a relatively slow process to obtain a grant and then to run the grant throughout its completion. Alternatively, Davide has already mentioned this, venture debt could be an interesting path as well. It is definitely a higher cost of capital. It could be relatively high interest, but it could be much quicker. And it would also provide little or no dilution to the corporate equity. If we look at this period may be lasting for a couple of years, right, where a first pilot or a number of pilots can be implemented, what would follow typically is project equity that would have to step in, where typically even a small tech firm would retain a certain minority stake, right? This could be set up in an SPV, in a separate vehicle, with the majority of it being owned by investment fund. But usually these funds require a small minority stake really from the developer as a type of first loss guarantee, a performance kind of buffer, and they just want to see some skin in the game from the tech company itself. Now, this journey usually is independent from the type of service or product that can be delivered. So we could imagine an energy performance contract, or also as a service or pay-per-use schemes. But what is important to understand is that in order to not take on more and more debt on the balance sheet that is relatively weak, project equity is much more likely going to be the go-to option in an early stage. So key considerations: bridging this innovation valley of death, as it's called, right, between basically a state where a technology is somewhat ready but not fully market mature, has maybe received grants but is not fully commercially viable. There are some bridging options to provide here. And the key consideration, clearly, as I mentioned more than once already, is to not dilute the corporate equity too much in the process. Let us now look at a different company. I call it Company B, right? A more mature company, probably already 3, 5, or 7 years in existence, had maybe a couple of equity rounds more, has a proven track record, has a mature technology, therefore also already a stronger balance sheet, and can potentially raise debt at lower interests, has access to different debt mechanisms. Here again, we have certainly I should say what will likely not be applicable here anymore is grant financing for this company. Why? It might just be too slow. At this stage, growing, expanding climate tech firm really requires speed in the growth. And this is particularly the case because the technology might already be known, might already be out there in the market, and to really solidify its market share, and also considering potential competition, faster instruments than grant financing will have to be applied here. Venture debt. So first of all, corporate equity, we have again a certain stack that we can assume. This also in view of potentially having an exit a few years further down the road. That could be a merger, an IPO, a management buyout. Again, there will be a strong interest not to further dilute the equity. Likely it has already seen a few rounds of equity raises, right, with different ownership in the meantime. When we look at debt instruments, venture debt is no longer the only or one of the key solutions. There could definitely be some cheaper debt finance solutions as well, such as asset-backed lending on mezzanine debt, that could be applied again to basically lead the company successfully to an exit in the future. When we look at project equity, however, we have a similar situation as described before. We have clearly a certain interest, a certain share that the tech firm will take in each project, but that even if it is in an SPV, if it is kind of separated out, likely will create a situation where more and more assets and therefore liabilities accumulate, and sooner or later there will be the need to refinance those assets. And what therefore is really of key importance here is that those projects, service products that are delivered should be delivered under standardized terms, standardized contractual terms, standardized risk profiles, so that they can more easily be aggregated, packaged, and then refinanced as a whole. And so the real growth with project investments really comes at the point where receivables can be sold, where factoring could be an option, or even potentially securitization of these assets. Just to conclude here, also clients could usually be already larger clients at this point, right? Creating also more interesting pipelines of projects. Pipeline risk clearly is a potential key risk at this stage, because there will be a lot of appetite for growth, and so a sustained pipeline of project opportunities will be of key essence. The other key risks here would be supply chain risk, the more technology that maybe has to also be imported. I would also include here the skill and labor shortage potentially, right, in the growth, and also ESG risks will be of higher importance at this point in time. Now, to conclude on this, we have some key considerations. A company will look to ensure growth through lower interest debt that will be available to a company in that state of development. They will look to free up the balance sheet through refinancing options and prepare for a possible exit a few years down the line. With that said, I want to conclude with just one slide to kind of give a quick overview on how SIFA and the work that we've been putting in with partners over the last years has really created a wealth of materials and collateral that help both on the project finance and on the corporate finance side. As you see on the screen, these include standardized off-balance sheet contracts. These are available in a number of languages. There's a risk assessment protocol covering 17 different project finance risks. There is everything else on ESG, KYC, standardized loan application, and so on. What is of key importance as well is that SIFA does not only provide those materials and also trainings on those materials, but clearly the introduction to funds and investors that can be facilitated, and also the networking aspect of joining the association and finding partnerships, be it for grant applications or other business development, is of high value, absolutely. So with that said, I conclude my presentation, and I'm looking forward to any questions there might be. Thank you very much.
Thank you very much, Michael. You just took one of my questions ticked already about how SEFA can support further. But I think what would be useful is to a bit open up the Q&A with our participants in the room. But I have just one question that I think it keeps on coming up. Why can't we scale up investment? I mean, a lot of people are talking about that there is money out there. There is a lot of private financing available, but still scaling up and is not developed as such. What are the barriers you think, from your point of view, are there, and how can we solve them to match a bit the finance and the project side?
Should I go first? Michael, do you want to get started?
You go first, Davide.
Okay. So as you saw from our slides, I mean, that is literally the $1 trillion question. So if I have the right answer, then that would be, you know what I mean. Having said that, and working in this sector since the last 15 years, there are several elements. First of all, as we saw, there's really good news, which is investments are scaling up, and the results that have been achieved in this sector in terms of volume of investments, creating a greenhouse of startups and new technology and operators in the sectors. And in terms of impact on climate change, if we focus on, for example, in this case on Europe, the results that have been achieved in the last 5 to 10 years are absolutely astonishing, and most of the analysts or scientists weren't able to foresee this kind of positive evolution. So today, no matter what you look at, from startups to investment funds in debt, in capital, and some of those funds are participating to these webinars, there are operators that are doing incredibly well, and they are growing. And now the European Commission is working with asset managers to kick off the first mega investment funds in climate tech, funds of over $1 billion or euros of asset under management. So definitely there is a growing momentum. You're right that this is not enough. So we cannot sit on these results and say that's great. This is just the beginning. And there are lots of barriers that needs to be addressed. The first one are the barriers that are structural. In other words, as you mentioned before, the work that Draghi has been doing with the Commission, we need to increase the productivity and the competitiveness of Europe and the European players and the European members. So the first thing is, many times for startup, the first barrier to address is scale in the markets that they operate. In other words, if a startup here in Europe has to be able to grow and develop its own solutions, first in Spain, and then jump from Spain to France, and then perhaps to a third country, and every time is a huge challenge, that is not scalable. That is just replicating in different countries what you are doing in your first country. And that's why so many companies go to look for funding and for deploying their solutions in the States. Because regardless of all the issues and problems that there are in the US when it comes to climate tech or energy transition solutions, still it is a much more integrated market than what we have in Europe. So first things is to address and to push, as Draghi puts in his plan, a further integration of the European markets at every level, from energy generation and distribution to deployment of solutions for consumers. The other thing is doing more, even though already a lot has been done to support SMEs and startups and companies that are intervening in these sectors. And doing more not always means to deploy more public funding, but being sure that the public funding is more effective. In other words, the one big issue that we see on the ground operating with companies and institutions in the single countries is that the European Union made a huge effort with the Next Gen and all the plans and funds that unfold from that, and close agreement with the member states for the national plans of resilience and economic recovery. And these funds have been disbursed either as subsidies or financing from the European Union to different member states, including, for example, Spain and Italy, that we know very well. And the issue then is when these funds need to trickle down from the local governments and local administrations to final beneficiaries, like companies, businesses, homeowners, consumers, citizens, etc. And that is sometimes creating a huge bottleneck and a huge effect of start and stop. Because if the subsidies are still not there, the market is still. Once the subsidies kick in, very often there's a lot of speculations and there's not enough capacity in the market. And then finally, these subsidies very often do not arrive fast enough. I mean, there are plenty of cases in which projects have been awarded subsidies 2 years after they still didn't receive the subsidies, regardless if it is for photovoltaics or for refurbishing buildings. Or like in the case of Italy, where there have been big problems with corruptions and scams. So the second element is really how to be sure that all the resources, all the policies, and all the mechanisms that have been put in place and that in our analysis go in the right directions, that can arrive to final beneficiaries in the right way. And the third one is the one where we are more direct involved, which is being sure that the right type of capital, private capital, is available for the right players, and that is ready to support, to boost, and to scale business in every given step of development stage that Michael very well explained in his example of basically the same company. He displayed the same company, but just in 2 different stages of maturities. There's and I'm done. In private markets, there's been a huge increase of funding from early stage and venture capitals to infrastructure funds, where the biggest players in the world, like BlackRock, Temasek, Macquarie, enter with the multi-billions-dollar funds to invest in climate tech infrastructures and energy transition infrastructure. So funds are being put together. Now is to do everything we can in order to be sure that those funds arrive not only to large corporations, but to all the thousands of SMEs, founders, operators, and startups that really can address these transition, not in a linear, but in an exponential way. So these are my 3 cents, my 3 points about the $1 trillion question.
Indeed, not easy, not easy. I don't know whether, Michael, you want to add anything else to this, and then I can open up a bit more the discussion with...
I'd be very brief, and I can definitely subscribe to everything that Davide already has outlined. It is at the core really also a communication gap. There is not really a financing gap as such, because capital is available and opportunities are more than available. There is a communication gap, and capacity building needs to be take place on both sides, right? Project developers who are not necessarily financially savvy, and financial funds, especially also maybe larger funds, pension funds, institutional investors who predominantly look at very large ticket sizes, who also have a strong appetite to be moving into this direction to kind of be able to support smaller project sizes in an aggregated way, right? Banks who also slowly but surely move in this direction, that it's not just, you know, one small department sitting somewhere at the headquarters dealing with climate tech and sustainable finance, but that this trickles down also within their you know, different branches, that there are products available in this sector. So just to say and complement basically what what Davide has already outlined.
Yeah. I do not know whether we have any questions from our audience. I think I have captured, let me see if I have any questions from the audience directly. I don't know whether anyone wants to raise his hands and they have any questions. But in the meantime, I see that there is a question that came in saying that, again, this is addressed to you, Davide, whether they mean that regulations, even within the EU, are not uniform, which lead to solutions not being scalable. So it's actually the gold plating, actually, issue, which is addressed here, I guess. That even though we have some EU regulations, when they are transposed into national regulation, that's not always the case. And there is some extra regulatory burden that it's being added to it. And this might be a hurdle for some solutions not to be scalable.
Yeah, I mean, yeah, thank you very much, Lina and Ankit. Thank you for the question. Yes, I'm referring to when EU directives like the recent EPBD or the energy efficiency directives and etc. Renewable energy efficiency directive that gets then implemented by member states. Of course, each member state has the freedom to implement the directive in the way that they believe it works the best for the characteristics and the idiosyncrasy of each member states. And sometimes I think that it works fine because, as I said, address the specific requirements and needs of specific countries. But on the other side, quite often reduce the capacity for innovators, startups, new technologies to have a wider adoption. And it requires more every time that a company wants to scale up the business from, let me say, the domestic market to new markets. Sometimes it's not about opening up their services and solutions to new markets, but basically developing new services and solutions for the specific market, and that it hamper the capacity of company of generating those economy of scales and those operational efficiency that would highly benefit the sector. I'm just closing with that.
Yeah, we have two more questions. I think, thank you for that, that you're also very active in the chat box. Whether we have any knowledge resources for small-scale, non-aggregated sustainability energy transition ESCO-type projects, or we have knowledge resources for products for ESCOs. So, Michael, maybe it's more for you.
Yeah. So we certainly have a wealth of resources and knowledge for small-scale projects. Ideally, we would work towards making them aggregated, so making them more standardized. So this is clearly the key intent of CEFA's project finance collateral, right? To basically provide a benchmark and a standard even across countries, right, in different languages and different legal systems. And so in this case, it is rather also for small scale developers, right? When we talk about ESCOs and rather large ESCOs, utility size ESCOs, these usually operate with their own, contractual templates and have basically their work and their processes carved out. So short answer, definitely yes. There are quite a lot of resources available, and we'd certainly be happy to have a conversation about how we could support.
Yes. And a final question is, how about regulations from Basel, making it difficult to give loans to energy efficiency projects that are designed to be cost neutral instead of making profits?
Well, I mean, very quickly on this one. I don't think that when it comes to Basel regulation, which the goal is to make it difficult for energy efficiency projects, but it is to regulate the financial services and lending markets, and of course the and amongst other things, the capitalizations of banks able to withstand stress tests and unforeseen events. So, in that regard, Basel has been, and it's the different reviews of Basel's have been working pretty well for the financial markets in Europe. But of course, that sometimes I can understand that it can be seen as limiting the capacity of company like ESCOs to grow in their own markets. Also, in that regard, there's a difference between different member states. In some countries in Europe, companies can offer lendings, and in some other lendings is limited to financial intermediaries. But there are always solutions. I mean, also because the ESCO business, I worked as a co-founder of an ESCO 15 years ago, and there's a lots of financing solutions that are available for ESCO, and lots of private capital investment funds that are that have been working and in this sector. So more than happy to try to discuss and address the specific topics. But the first thing is to be able to reply to those questions that we display at the beginning about your business, your technology, the portfolio, the counterparty, as Marco suggested. So once you have a clear profile of all the risk and the different drivers of your business, from market and financial risk, credit risk, or off-taker or counterparty, technology, project execution, so the EPC risk, operational like O&M, liquidity, etc., then it generally comes pretty clear what is the kind of solutions that can be offered to a certain operator.
Thank you. I think we only have 1 minute left. I think we also have some more interesting discussions about in the chat about private home owners for retrofitting energy performance contracts. It's very interesting to see the chat, and I think that this creates a bit more momentum also on the topic of retrofitting, and this could also be a very interesting topic for our maybe a next webinar where we can host. I would like to thank both Michael and David for their interventions today, but I want to keep 4 messages that are important. So it's about, so if we really want to scale up investments and we really want to have some in energy efficiency projects, of course, it's all about competitiveness. It's about making public funding more effective and more adaptive to the local and regional needs. It's about making sure that we choose the right type of private capital for the right stakeholder. But it's also, finally, it's about communication and capacity building, that it's important also to make sure that you have the correct stakeholders on the table where you are discussing the where you are discussing, of course, the company scenarios or the project scenarios, etc. So I would like to thank everyone for being here. If you have more questions, please do drop an email. We're going to put our info at cefa.eu towards the in the chat as well, and we are more than happy also to discuss further with you. Thank you again.
Thank you.
Thank you.